Hey guys, welcome back to this episode of the Nomad Show. So, in this episode, we're going to focus on the key things to look out for when investing into a company, right? Whether you're buying into the company shares or you're trading the share options, right? So, the framework that we are looking at below will be highly relevant to both types of assets. Okay, so point one, the first thing to look out for when investing in a company is the economic moat, right, that the company has. So with this, we're talking about things that protects the companies from competitors. Okay, so think of a company as a castle, right, and the moat is the water surrounding the castle. So the bigger this body of water, right, the further it goes, then it becomes harder for enemies to invade this castle, right? So, in a business context, these will be the things that protect the company's positions, right? Their financials, so that it makes it very difficult for competitors to compete with them. In that sense, they can actually protect their profits. Okay, so examples of economic moat could be things like a strong branding, right? People recognize the brands of this company, the products, so people will attach a certain feeling or a sense of loyalty to this company, and they are unlikely or less likely to switch to competitors. Okay, so an example could be like Apple, Coca-Cola. So these are very strong brands with products that people recognize easily, right? So if today I were to start selling a new brand of smartphone, right? People may not have heard of this before. So I may not be able to snatch, right, Apple's customers away, right, with my products because people may not recognize my brand. Okay, so in that case, I may need to charge a lower price, right, in order to compete based on low pricing, right, rather than on premium pricing or and so on. Because for now, right, my branding is not as strong. Okay, so that could be one. Then another level of another kind of economic mode, right, would be the network effect. So this is where as more people use it, right, then more people will be attracted into this community, right, to use the product. So think of, say, the Microsoft, right? Microsoft Word, Google Docs. So it is something that most of us, right, especially those who are studying or even working, they use on a daily basis, right? Whether we're using Google Docs or whether we're using Microsoft Word, right, PowerPoint, and so on. So because so many people are using, right, and the file formats, right, when we save and when we send them via emails, right, to the other party, right, most likely they'll also be using this. And the more people that use this, right, it becomes harder to switch out of these products, right? Imagine again now, right, if I were to produce a substitute, right, to Microsoft Word, and my file format when saved, right, is not dot it's not PDF file, so it's another new format. So in that case, when people want to open this format with the PowerPoint, or let's say with the Microsoft Word, right, they cannot. So it becomes very hard for people to accept this brand, right? Because since many people are using this, right, and then us adopting a new unknown program and using a new file format, right, wouldn't be accepted easily. So why go through this ordeal, right? Why not just continue using Microsoft Word, right, for example? So in that case, because this is how people feel, it makes it hard for us to compete with Microsoft Word, right, their products. So in that sense, Microsoft has actually built this strong economic moat for their products, right? It becomes very hard for people to switch away from, and they're almost a monopoly, right? Almost, right? On this types of products, okay, for use in the office, in the university setting when we are producing documents and so on. Okay, so whether a company has economic moat, right, and whether it is a strong level, right, strong intensity of moat, that will really help us evaluate the company. Okay, so if the company has strong economic moats and multiple types, right, then it will be in a better position to protect itself. Okay, so the second point to look out for would be the financial health, right? So this is looking at the financial statements, namely the income statement, the balance sheet, and also the cash flow statement. Okay, so predominantly, if you look at the level of profits, right, then we are looking at the income statement. So ideally, right, a company that we are looking to invest into would have higher and higher revenue every year, right? So it has to be positive. That means they're earning something every year, every period, right? And this amount that they're earning is more and more, right, every period. So that will be a good sign. Okay. Then also, if you look at the profits, right, the profits have to be rising every period as well, and ideally it should be profitable. Okay, so if you are looking at a company that has negative profits, right, last quarter, and then this quarter it has turned profitable, there's also a chance that in the next quarter it may lose that profit, right, or it may just see a reduction in the profit. Then in this case, because of the uncertainty, the volatility of the profit level, then it may make it less suitable as a candidate to invest in, right? Let's say if you are looking into a strong company, then this may not be the kind that we are looking for, right? Then if you look at the balance sheet, so this statement, right, this financial statement is going to list down, right, what the company owns, what it has as its assets, and also its liabilities, right? So if it has more assets than its liabilities, right, and generally as a rule of thumb, then it means that even if the company has to pay off its suppliers, right, whoever has lent them money, all of a sudden, then it actually has enough assets to pay it off at the current moment. So if it doesn't, right, then there is always this probability, right, this risk that the company may have to be liquidated, right, to become insolvent. So in that case, it may not be ideal, right? It may be a bit risky, because it doesn't have enough assets to cover its liabilities, right? You want to see how much it owns and how much it owes to other people. Okay, so ideally the assets should be more than the liability. In terms of the cash flow, so the company should also have a positive cash flow, right? That means looking at its operations, looking at what it does on a daily basis, what it sells, then reducing all the amount that it pays to its suppliers and so on for advertising, right, for its staff. There should be a positive cash flow every period, right? So that there is more and more cash coming in, and then they can do something with the cash, right? So this is also another thing to look at. So what are they actually doing with the cash, right? So first is of course to have the cash coming in. Then second of all, to see what the management does with the cash, right? So if just holding on to a huge amount of cash, then there may be an opportunity cost, right? Because you could have done something with the cash to generate higher returns, whether now or in the coming period. Generally, as a rule of thumb, if you have a healthy financial position, right, higher profits, higher revenue, and then also you are having more assets than liabilities, your debt level is controlled, right, and you are doing something efficient, right, with the cash, then this may be a company that we can look at potentially to invest in. Okay. Then the next point here, point number three, right, would be the type of industry. Now, with this definition, we are not looking at whether they are the oil and gas sector or whether they are in the EV sector and so on, but rather the way that we classify them, simply, we are looking at them as whether they are a stabilizer industry or whether they are disruptor, right? So a stabilizer industry will be something that we use every day, right? They sell products that we use every day. We are familiar with the product offerings. There is nothing too different, nothing too creative. And in terms of the consumption, it's also stable, right? So think of things like let's say utilities, right? Let's say cars, let's say consumption goods, right? All these consumables. So these are things that we consume daily, right? We are used to seeing them, we are familiar with them. So there is nothing too new to the idea of these products, right? So this is something that we're familiar with. Now, in contrast, let's say we look at the case of a disruptor industry, right? This will be something that is not yet readily used daily, right? For example, if you know about SpaceX, right? they are coming out with a space travel service soon, right? So they are still testing this idea. So for now, this is not commonly used, right? We don't go to space every day now. And whether or not it is profitable remains to be seen, right? It could be in the future, right? But it may not be in the current period. So then in that case, when we look at our portfolio, right, it is not to say that this is something too new and we should never even consider it, right? Because if we backtrack, right, decades ago, if you look at the idea of a smartphone, right, it may be very different. It may be very wow at that time to the people. If you look at the idea of Netflix, right, Airbnb. So the traditional industries were like the hotels, and also people probably went to the DVD shops to rent or to buy the DVDs, right? And they don't have such a service where you can just watch everything from your device and you don't need to go somewhere to actually rent the shows. Okay, so if you look at back in those times, right, Netflix, Airbnb will be seen as disruptors because they were disrupting the industry, right? But right now in 2024, right, these are very profitable companies, earning millions and billions of dollars. So these companies have the potential to make money, to make huge profits, right? If you had bought into their shares earlier on and held on to it until now, then you probably have seen a massive jump in your portfolio size. Okay, so these companies are still acceptable, right? We should still consider them. But in terms of your allocation, if you're someone more risk averse, then probably we do not allocate a big proportion of our portfolio to these companies. Okay, so we want to choose something that's more safer, something that's more stable, right? So that it is a bit more secure, right? Especially if we are more risk averse. Okay, so that will be point number three. Now, point number four, we look at the dividend history, right? Whether they have a history of declaring dividends, right? Now, certain industries they actually do have to declare dividends, right, as a practice. So let's say like REITs, right, real estate investment trust. So if we do buy into REITs, then we will be receiving the dividends regularly, right? This is what the law mandates, right? So they have to provide the dividends. So these companies that provide dividends will be providing some returns to the shareholders, right? So as an investor, if we prefer such regular payments, right? Let's say in Singapore's case, some of the REITs provide quarterly dividends. So every quarter we can expect to receive some money, right? Based on how many shares that we hold. So the more shares, of course, the larger this amount is, right? And for some, they may prefer a very passive approach. They don't want to monitor their portfolio, right? But they prefer to just wait for the cash to be dispersed to them, right, on a regular basis. It be a good amount to offset their daily expenditures, right? So in that case, they may prefer a company with dividends, right, to another company which doesn't do such a payout. This is, of course, this may not be a determining factor, right? So you have to look at the whole company situation collectively, right? It's not just whether they provide dividends or not. Although if they do, right, and if they are in position to provide dividends, then it may be a plus point, right? Because in that case, we would be getting some returns along the way while we wait for the shares to appreciate in value, right? If you choose to buy the shares. Okay, but of course, if we just buy the option contracts, then the dividends wouldn't be that relevant for us, right? Because we will not be entitled to that. So the last point is in terms of the valuation, right? So valuation is about using the methods to calculate a fair value for a company. Okay, so there are many methods to go around. We can look at the price earning ratios, we can look at the discounted cash flow methods, and so on, right? So these methods here, they do not provide a uniform number, right? So they may all produce different results in terms of how much a company should be worth. Okay, so when we're using these methods, we may need to take a range, right, or to accept a range of numbers or of prices, right, as a fair value. So, for example, let's say we're assessing the fair value of Microsoft, right? Then, say, for example, method 8, right, produces the result of $500, right, as a fair value, whereas method B, right, produces a result of $400. So in that case, our range will be between 400 to 500, right? So we take this with a pinch of salt, okay, because this range is actually quite huge. If you have other methods you can use as well, then that may help us to narrow down the range. But the idea is this, so it's between 400 to 500. Then we may want, so depending on ourselves, right? If we have a larger portfolio and we are comfortable buying at 500, which is a higher price, right? Then as long as Microsoft hasn't hit 500 yet, then it is considered to be undervalued, right? So we may choose to buy some shares before it hits $500 and hold on first, right? And wait for it to appreciate, right? But there's also a chance that at 500 or even less than that, right? It may never go that high for a long time. Okay, so if we want to be safer, right, we can take 400 as the benchmark, and then we only buy when the price reaches $400 or less, right? But the trade-off is if it's at around 450 right now, right, and waiting for it to go down to 400 may be a long shot because this share price may not fluctuate so much, right? So if we were to wait for 400 to come again, right, then we may be waiting for the next downturn, right, in the stock market. So that could be years before we buy into Microsoft and wait for it to climb back. Okay, so in that case, we may miss the boat, right? Suppose it doesn't fall and it continues rising. Okay, so again, this is looking at the personal preference, right? Looking at our portfolio size to see whether we intend to hold first or we are okay with buying it at a higher price, right? In case we miss out, but also with the risk that it may continue to drop later on, right? And we would have bought at a higher price as a result. So these are some of the points that I personally use when trying to evaluate whether a company is worth investing into, right? But of course, this is just part of the whole framework, and we should also look at our own risk appetite, right? What is the time horizon that we are comfortable holding the shares with for, and also what strategies that we're looking at, right, to provide a holistic picture as to how we're going to enter into a position. Okay, so hope you guys have enjoyed this episode and taken some notes, right? And you have learned something here. So we'll be back with the next episode to talk more about investing and business. See you guys.